Alright, hey guys, Scott here again with a brand new video, and so in this one, I'm going to walk you guys through a more advanced delta hedging technique, which I basically invented and that I've been using to try and save a few of my losing option positions. Right, so essentially this is my way of trying to give myself a second chance of making money on the position, actually more like a third or fourth chance. So basically this is kind of a last ditch resort that I would use when I'm pretty much out of choices to try and turn things around. And so for this video, we're going to focus on my position here in RCO, which is Royal Caribbean. And so I used this technique this morning. So again, here we're going to focus on this trade. And I'm going to walk you through all the different adjustments and explain how everything works here. Now, briefly though, before we dive in here, if you guys want to learn how you can automate your exact option trading strategy and perform detailed trading research with things like backtesting software and simulations, then make sure you watch until the end of the video. And then also, if you want to join a very exclusive online community where you can learn how to trade options and my overall approach to the markets, then you can now join my options trading Discord as well. So definitely check out the description of the video below to learn a lot more about that. And then lastly here, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the video description as well. So be sure to check them out. And when you join SKILLSHARE using those links, you'll get a full 1 month free trial. Alright guys, so now we'll dive in here. And first off, let me give you some brief context around this trade I made here in Royal Caribbean. So we'll go ahead and zoom in a little bit here on the charts. So basically, as you can see here with this white line, I noted this pretty significant resistance point, which comes in at around $50 per share. And so I believe it was on this day right here where I saw that the stock had reached this resistance level and did so pretty quickly. And as a result, I sold some naked call options with a 51 strike right around here. Right, so this is basically a bearish position where I want the stock to get repelled off this resistance level and go back down lower. And so given that this stock here has very high implied volatility, which you can see down here at around 81%, that's why I chose to sell options to play for a downside move as opposed to buying options. Now that being said, pretty much 100% of what I do is only sell options. I'm basically just an option seller, but my overall strategy at least is to sell naked options, in this case here, naked call options, but also I will either buy or short the underlying stock to defend my trades. Right, so when it comes to selling naked call options, if I'm wrong on the trade and the stock continues to push higher and goes above my call strike, at that point I have automatic orders in place that are set to buy 100 shares of stock per contract. And so as a result, I basically convert my initially naked call option into a covered call option. So therefore, it does not matter how much higher the stock goes after that point. Right, because as long as I buy the stock roughly around the strike price of the call option, then perhaps by expiration, if I get assigned on that contract, I'll have to sell those shares again, basically at the exact same price, right on that call strike, but I will still get to keep the call premium I collected when I first sold the option. So bottom line here, even though I want the stock to go lower in this case, that would definitely make this position very easy to manage and profits would come pretty quickly. But if I'm totally dead wrong on the trade, I still have the potential to make money at least by the expiration date. And so as you can see here on the chart, after I sold those call options on this day here, for a very short period of time, I was actually correct in my assumption. RCL was getting repelled off that point and moving lower, but that was very short-lived. So obviously a few days later, the stock had made even newer highs, and at this point, during these 4 days, it was breaching my 51 strike call options. And so again, like I explained, I do have automatic orders in place that are set to purchase 100 shares of stock if it does breach my call strike, but then also they will automatically sell the stock if it goes back down below my call strike. Now, just as a side note here, if you do want to see how I do create these orders here in thinkorswim to basically create a chain reaction of orders that will flip-flop between buying and selling the stock automatically, I'll post a link above to a separate video that focuses on just that topic. But basically the way I do this is for this trade in particular, my orders were set to purchase 100 shares of stock per contract. Also, I did sell 3 contracts, so in total that's 300 shares of stock at a price of $51.50. But then if after that point the stock then goes back down below a price of 51 exactly, I have orders to sell the stock and get rid of them. So real quick, just to make this a bit more clear, I'll go ahead and pull up the calculator. So again, as I said, my buy orders are set to purchase shares of stock at a price of $51.50, 50 cents above my call strikes, right? And then also I'll make this a negative number to represent this as a cost, right? It costs money, of course, to buy stock. But then also my orders are set to sell the stock if it falls back down to a price of exactly 51. So therefore, if that happens, I would lose 50 cents per share, which in this case, because I'm dealing with 300 shares of stock, the total loss would be 150 bucks. Now, if this kind of thing does happen once or two times, it's not a big deal because don't forget, because I sold these call options, I have collected some premium up front. And so specifically for this trade, because again, I sold 3 call options, each for a credit of 142 bucks. So times 3, my total starting credit on this trade was $426. And so ultimately, because as an option seller, you always get to keep that premium as long as you hold the trade to expiration, then again here, if I lose 150 bucks from the stock going through my strike one time, it's not a huge deal, right? Because in this case here, by expiration, I'll still get to keep the full 426 bucks in premium. So therefore, the difference is 276. I would still make this as a final profit. Now, sometimes though, as was the case here with RCL, sometimes the stock can be very stubborn, and once it reaches your call strike or your put strike, it might just stay there for quite some time and just fluctuate through that strike multiple times. And so as you can see here on the charts, for 4 days in a row, the stock was just fluctuating around my call strike of 51. And I believe it was on this day in particular where this stock just perfectly pinned my call strike and bounced through that level of 51 like 4 or 5 times in that one day. So bottom line is, if I lose about 150 bucks every time that happens, then you can do the math, right? If that happens 4 or 5 times, that's going to be a total loss of hundreds and hundreds of dollars. And so the good news is that number one here, this kind of thing does not happen very often, but of course it will happen from time to time. But number two, also, there are ways you can make adjustments to this trade to try and still make a profit by the expiration date. And so now at this point, we'll go to the trade tab and take a look at the option chain for RCL. In this case, as you can see here, I'm in the September 30th expiration, now only 8 days left to go. And again, as you can see here, this was my initial position where I was short 3 call options with a 51 strike. Now on that particular day where the stock was just bouncing through this strike again and again and again, and as a result I lost well more than my starting credit on this position, I therefore had no choice but to make an adjustment to collect more additional premium. And the way I do that is by selling put options. Now normally when I do try and make this adjustment, I will choose put options pretty far away from my call option here and therefore give myself a pretty wide strangle. But in this case, because the losses on the stock were just so great on this one day, I had no choice but to sell a put option very close to my call option here. So specifically, I sold 3 put option contracts with a 50 strike and basically converted my position into a $1 wide short strangle. However, by doing so, I was able to collect additional premium that was more than the full amount of losses I took from having to repeatedly buy and sell the stock over and over again. Right, so actually the net effect of doing this was I now had more premium than I had at the beginning of the trade. But also, of course, the main caveat as well is I now have, as I said, a very narrow strangle. So at the time I made this adjustment, RCL was right around 51 bucks per share. And with a position like this, there's basically a guaranteed certainty that this stock is going to move beyond either one of my strikes. And so in regards to RCL here, this stock finally did make a move, and this time to the downside considerably, which of course meant that I now had to defend my short put option, right? Again, if the stock does breach my short call strike, I will buy the stock, but if it falls below a short put strike, I will short the stock. And so bottom line, that was the current state of my position here up until this morning. I had a very narrow strangle on, 51 strike call, 50 strike put, and also I was short 300 shares of stock for the 3 contracts that I have on right now. Now, if the stock was to stay below my 50 strike puts here by the expiration date in only 8 days, then the net result of all these adjustments would be a very small loss of about 50 bucks or so by the expiration date. Right, because ultimately before RCL finally did move down considerably here, It first did bounce through my put strike and my call strike a few more times, so therefore I gave back much of my additional premium. And then also there is still the risk that in the next 8 days, RCL could recover and bounce through my strikes multiple times again. And therefore, I would just keep racking up more and more losses, and at this point, I'm pretty much out of adjustments. I could perhaps consider rolling my put option from the 50 strike to the 51 strike and collect a bit more of additional premium. But then at that point, I'm totally out of more adjustment choices, right? Once I roll my position to a straddle where both the call strike and the put strike are the same, I cannot collect any more additional premium. However, this is also where the more advanced delta hedging technique comes into play, because also don't forget that I was short 300 shares of stock up until this morning. So therefore, for each $1 the stock drops after that point, I'm going to profit $1 per share. But also, as RCL continues to fall here, I'm going to lose more and more money on the put option as well, right? Because this contract here is going to continue increasing in price, which is a bad thing for me as a seller of these put options. Now that being said though, whenever the stock does breach the strike of any option contract, the delta on that contract is going to be about 50. And so this means at that point, if the stock does move by $1, then the price of the option is going to change by about $50. So for example, in this column here, you can see the deltas of all the different put options. And also you will notice that the deltas do increase the further the option goes in the money. So right now the delta of my initial 50 strike put options is 66, but again, at the time that RCL was right around this price, once it crossed down below it, the delta was only about 50. So therefore, if I bring back the calculator real quick, so if at that point, once RCL falls down below my 50 strike, and therefore my automatic orders are set to short 100 shares per contract, well then if the stock then does drop by $1 more, I'm going to lose $50 on the put option, right? Because again, as the delta shows, the price of that put option is going to increase by about $50, and therefore I'm going to lose that amount, but I'm going to profit $100 on the 100 shares I'm using to cover that contract. So ultimately, I still make a profit of $50, which times 3 for the 3 contracts and the 300 shares of stock I'm short, that's an overall profit of $150. So bottom line, the profits I make on the stock position more than compensate for the losses I face on the option. And therefore, as the stock continues to drop further and further and further, I'm going to make more and more money back up until a point, right? Because also, as I showed you here, the deltas on in-the-money contracts will increase the further in the money those contracts become. So that's why my deltas here on my original 50 strike put options have increased from 50 to now 65. But I would still make more money back if the stock did drop further, because again, I'm going to profit $100 for each $1 the stock drops on those short shares of stock, and I'm only going to lose $65 on the put option. So once again, the net effect is I still make some money back. So now if we go to the monitor tab here, I can show you the orders I made this morning. As you can see here, I bought back to close my 300 shares of short stock in RCL. And also, I rolled down my put options from the 50 strike down to the 46 strike and did so for a debit. But as you'll see here, the profits I made on the stock more than compensated for the debit paid to roll down the put options. So once again, we'll bring back the calculator. And so once RCL fell down below my 50 strike put options, my automatic orders were set to short the stock at a price of $49.50. Although in this case, the actual fill price was $49.51. And then as you can see here, I bought back those shares for a price of only $47.06. So I subtract $47.06, and therefore I made a profit of $2.45 per share times 300 shares. That's a full profit of $735. Now, like I said though, I use this money to basically pay for the debit to roll down my puts from the 50 strike down to the 46 strike. And the reason as to why I did this will become more clear in a moment. And so for each contract, I had to pay a debit of $230. So times 3 for 3 contracts, that's a total debit of $690. So I'll come down here and subtract $690, and this actually still leaves me with a little bit of profit left over, $45 in this case. So now the full combined effect of doing all this is I was able to widen my strangle back out again, increase the width of my strangle here, and get paid 45 bucks for doing that. Right, so otherwise, without having the short stock position, I would have had to pay a huge debit to achieve this, which basically would have defeated the whole purpose. But because in this case, I was able to widen my strangle back out for free essentially, I now have the opportunity to make another adjustment if need be to collect a lot more in additional premium. Right, so for example, if we go back to the trade tab here, now as you can see, my put strike has been moved from the 50 strike down to the 46 strike. So like I said, I now have a much wider short strangle position. And at the present moment, if RCL stays in between my strikes in the next 8 days, and therefore both options expire worthless, I will still walk away with about a $150 profit. But if the stock does drop down to my put strike once again, or increase to my call strike, and perhaps bounces through those strikes once again, and therefore I lose a lot of money from buying or shorting the stock over and over, then at that point, I can roll in one of my contracts here and collect a lot more premium, right? So for example, let's say RCL falls back down to 46 and bounces through my put strike multiple times. I lose some money. Well, in that case, I can roll down my call option from the 51 strike down to maybe the 47 or even the 46 strike. So real quick, I'll go ahead and right click on the 46 strike call and go to sell and vertical. And here we go. So this one order is set to buy back my existing 3 51 strike call options, and also at the same time sell 3 more call options with a 46 strike, right? So basically this order has the effect of just moving down my calls. But also here, take a look at how much additional premium I can collect for doing this. Now, if RCL was actually down to 46 bucks per share, right now it's at around 47.5. This premium would be a bit less, but still pretty darn satisfactory, right? So maybe it's 150 bucks, which times 3 contracts, right, would be a total additional premium amount of 450 bucks. So that could be a huge help to me if, again, RCL does drop down to one of my strikes or increase to one of my strikes and bounces through that multiple times and I lose some money. But all of this would not be possible if I still kept my existing position with the 51 strike call and the 50 strike put options, right? Like I said, once you get to a straddle position or a very tight strangle, you cannot move your strikes closer together after that point. But again, by using a corresponding stock position to pay for the entire debit needed to widen the strangle back out again, that therefore gives you the potential to make another major adjustment to collect a lot more additional premium. And so with all that being said, that is the more advanced delta hedging technique, which I basically invented and I've been using pretty successfully. So I do also know this can be very complicated stuff. So feel free to ask any questions that you want in the comment section below, and perhaps also watch this video a few times. And so that's going to do it here for this video. But of course, one last thing, as I mentioned, if you guys want to learn how you can automate your exact option trading strategy and perform detailed research with things like backtesting software and simulations, then join Option Alpha today for a free 30-day trial. And so this powerful and very easy to use software allows you to rapidly configure trading bots that will execute your exact trading strategy automatically. Right? So it's the perfect way to eliminate human error and emotion from your trading while also ensuring that your portfolio is always being actively monitored and managed while the market is open. And you can also use Option Alpha's powerful backtesting software to improve your strategy by continuously testing and refining your approach over decades of stock market data. And finally, the Option Alpha platform offers a huge online community where you can engage in discussion with other traders, get answers to all of your questions, and find inspiration for new trades and strategies. And so if that sounds good to you, then use my link in the description of this video to sign up and begin your 30-day free trial. And also don't forget to check out and join my options trading Discord as well as my SKILLSHARE courses. Links also in the video description. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.